I think in the U.S., I think investors are about right. I think being overweight the U.S., I think that home bias is actually appropriate right now. And I think the non-U.S. equity outperformance of the first half will prove to be relatively short-lived. I was in...
You say the worst is behind us.
Worst of the tariff uncertainty, yeah, I agree. I think it is. And I think you're in a de-escalation phase there. I wasn't surprised by the president's kind of slapping around of Europe on Friday. There was a little bit of complacency, I think, both amongst the negotiating parties and the market that, once he had de-escalated, that was it, and you could kind of slow walk it. So he needed to kind of shock the system a little bit. I also wasn't surprised when that had its intended effect and he pushed back out to July. But Tom, talking to investors outside the United States, they were shockingly underallocated to the U.S. You have folks on the mainland with maybe only 20% in U.S. equities, which is 60%, 70% of the global market cap of the kind of MSCI world or MSCI all-country world. And so I think there's still buyers to come into this market. And I think the most likely outcome here is a slow, soul-crushing grind higher in U.S. equities that will pull the skeptics in over the course of the year.
Soul-crushing grind. That was on Emerson, Lake and Palmer's third album.
Exactly.
It's a great song. Soul-crushing grind.
What's the Federal Reserve going to do here, given some of the economic data we're seeing here and some of the uncertainty that from the tariff discussions?
Look, I find some of the rhetoric and certainty out of the Federal Reserve a little surprising. I get wanting to be patient. I think that's right. I think if you think thoughtfully about any impact of tariffs, the impacts are much more severe on growth than they are inflation. And I think you have an economy that is slowed and a consumer that's under some pressure. So I hear them talk about patience. I think they're going to cut this year. They just don't know it yet.
You have an advantage of adults at Federated. How are people old and grizzled? I mean, you're doing asset allocation and that, and your clear memo is buy American, buy technology. Is that what your portfolio managers are doing?
That's what we did this cycle. We said at the beginning of the year, I was on this show, that we were strapping ourselves to the mast. We weren't going to get caught in the emotional, turmoil, and that we wanted to add to equities through the distress. And we did. And where we added, Tom, was in large cap growth. You got the Mag 7 and the large cap growth index somewhere around 6 multiple points below its 3-year average. You don't pass on a 6 multiple point discount with companies that are generating the kind of cash flow and growth that those companies are. And so that was the buy this time around. I'll tell you, I still think, and I know it's been waiting for Godot, but I think the second half story is going to be ones where small caps and cyclicals assert themselves as well.
So what do we had the U.S. debt downgraded. I mean, does that kind of call into any question recession risk here? I mean, or are we just kind of a slowing economy grind higher?
As goes the U.S. consumer, goes the U.S. economy. And as goes the U.S. labor market, goes the U.S. consumer. Right. And here's the thing, and here's why I don't buy into the kind of recession views. Companies had a wonderful excuse if they wanted it to lay off workers last month. Yep. They had tariff uncertainty. They had growth slowdowns. They could have slashed their guidance. They didn't. They pulled it in some cases. Yep. And they didn't take it. And I think this is the lesson of 2020 when folks, companies fired folks, and then it took them 3 years and 30% more to hire them back. And so unless you see that labor market break, I don't think you have recession on the table. I'd also say, Paul, that there's this wonderful romanticism around the bond vigilantes, and that's what's pushing yields up. But that doesn't explain German bund yields. That doesn't explain Japanese government bond yields. And if that really is a story of 3 separate bond market issues, would you rather buy the bund when they're raising debt to buy bullets, or would you rather buy the U.S. Treasury where they're raising debt to stimulate?